Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, we have two new releases for you, as over these past couple of weeks we've been really focusing on this economy, especially with some of the pressures coming to bear with a weak employment number this past Friday. Once again, when we were looking at jobless claims going up to 385,000, is that it pretty much fit into here the Fed Philly February state coincident indexes 3-month change. And this would pretty much play out when we look across the country in terms of going all the way from negative growth in Wyoming and Illinois into much more positive growth with the dark green states moving up about 1% in, or greater than 1% in Texas, Georgia, and North Carolina. This pretty much follows, in my mind, with unemployment pretty much sticking to where it is, and also looking at GDP being in that very low type region of maybe somewhere between 0 and 1%. But we've kept saying what we need to have is something predictive, and where the 6-month leading index pretty much look like this going forward in terms of last month's. Interestingly enough, there's been a pretty big change. And even with the fact of the sequester, is that suddenly we're looking at much more dark green moving throughout the country, being added by really almost the entire Pacific Northwest, as well as the Southeast, up into Pennsylvania, and then through New England. This would suggest, as we look at this, is that we could have an economy that might get more robust as we come through the next 6 months. Maybe moving more up into that 2 to 3% GDP level, but once again, probably not providing enough overall employment in here to really have the Fed stop in terms of their overall buying. But this is definitely some better news than what I was talking about previously. But once again, we want to think forward in here. And one of the things that we've been noticing are banks talking about they're not meeting budget in terms of their net interest income, which we put as a strategic objective in here for 2013. That on a dollar basis, banks need to be able to grow, to be able to maintain or at least increase in dollars their overall net interest income on the income statement. So when we look at it, is that here's an example bank, for instance. And in 2013, for instance, this particular bank has close to $31 million running off through the end of this year. And you can look at it from the standpoint, the average investment yield they have is a 3.1% on that 31 million. Well, a 3.1% is pretty difficult in order to reinvest in this particular environment, as we all know. But to what degree is it going to drop that net interest income? Well, for instance, if you reinvest at 0.5%, that means there's going to be negative 800,000 worth of annual income. 1%, 649,000 terms of negative. Looking at even 2% would be 341,000 negative income, and once again not staying into the positive unless they can get over that 3.1%. So you need to be able to have this analysis in here to know what impact your runoff, your prepayments are going to have on your investment portfolio. You then have to say, well, how much faster do I have to grow loan and investments to be able to make up for this income loss? And that will help you in terms of managing that net interest income in total dollars. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.